So F&C Investment Trust is a growth-focused trust, so our focus is very much on listed equity and also private equity. We are diversified, investing a range of active strategies which are managed either internally by Columbia Threadneedle or also drawing from external management groups. We've been relatively cautiously positioned over recent months. We're essentially concerned about the inflationary backdrop, rising inflation rates across the world, leading to central bank tightening in terms of interest rates and general liquidity conditions, and also concern about deteriorating growth, not only in 2022, but looking forward into 2023. So what that meant was we cut gearing early this year, we raised cash levels, and we adopted a reasonably cautious approach in terms of our underlying investments. We did make some quite significant changes in the portfolio prior to coming into this year, which we carried on in the early part of 2022, which was essentially making significant divestments from US large cap growth stocks into more income focused areas and also value stocks in the US. And those decisions have paid off from a performance perspective. We also had a long position on sterling, and we cut that earlier this year in advance of the very sharp decline which subsequently unfolded. And we've continued to make selective investments in private equity markets, which are now around about 12% of portfolio assets. And they've held up relatively well despite what has been quite significant and widespread market weakness in the listed space. And the area of most significant exposure on the portfolio continues to be in US listed equities, where we have over 50% of assets by value in that area. Well, it's been a very tough period for equity markets in particular, and also fixed income markets generally as well. Equity markets have derated significantly year to date, meaning that valuation levels have come down as interest rates have risen. And despite that, actually as we speak, we're trading in share price terms very close to record highs. And we're up around about 2%, again in absolute terms, year to date, which I think is a really good outcome given generally negative markets globally. Our underlying net asset value is down modestly in absolute terms, and the share price total return has been helped by a narrowing in our discount to around about 2% at the present time, and that's narrower from the start of a year level of just over 5% discount. Our relative performance has led us to being included once again in the FTSE 100, not for the first time, and that reflects strong performance over an extended period of time. And our returns put us ahead of both benchmark but also top quartile against peers year to date. We're also top quartile against those closed-ended peers over 1, 3, 5 and 10 years in both share price terms and NAV terms, and ahead of open-ended competitors. So I would say it's been a really tough period for markets overall. It's pleasing to deliver at this point an absolute positive return in shareholder return terms and good returns against competitors. So we've now navigated markets, I think, relatively well, cutting gearing early this year, as I said, made good returns from debt revaluation, where we had issued substantial long-dated debt at very attractive borrowing rates and fixed in low interest rates for many years hence. And our underlying portfolio in terms of listed and private equity has held up relatively well, again, given the prevailing backdrop. So we run a diversified portfolio in listed equity and private equity, but a couple of holdings of interest and I think great prospect in terms of future return from our perspective are firstly Air Products and Chemicals, which is a US company, and that specialises in industrial gases and chemicals. They take advantage of some bigger picture trends, essentially the trend towards greater adoption of batteries and hydrogen producing electrolyzers, and as we move towards more by way of renewable energy sources, clearly there's a greater need to find cost-effective ways to store this energy so that it's available when it's needed. And obviously, as we know, one of the issues with renewable energy is that the primary energy source can sometimes only be available on an intermittent basis. So you need to store that energy and use it not just when the sun is shining or when the wind is blowing, for example. So this company is taking advantage of some of those trends, and hydrogen is preferable to batteries for many of the heaviest jobs, basically due to liquid hydrogen's high energy density. And the challenge to hydrogen adoption so far has been cost, and therefore investing in companies which are developing economies of scale in production provides an attractive investment opportunity from our perspective. And Air Products and Chemicals has got more than 6 decades of experience and knowledge in all aspects of the hydrogen value chain. So we think that they are very, very well placed in terms of their position in the future. And also we think that given some of the large scale projects that they're currently looking to provide capital for, that the company will evolve from an industrial gas company to potentially a much faster growing clean energy transition company. The second company which I would highlight on the portfolio is ASML, and ASML's products enable the manufacturing of ever more efficient semiconductors, reducing energy requirements, improving productivity for both consumers and producers, and they've got a unique technology. While other companies do produce lithography systems, their platform is really leading in the semiconductor space. Because their technology can pack more transistors onto a single chip, these chips can be mass produced affordably. They've also got faster and more extensive processing capabilities. They use less energy, higher performance, and that in turn enables many applications, whether it's smart cars, phones, homes and so on. They're also aiming for 100% renewable energy supply by 2025. So we think they're extremely well placed as essentially quasi-monopolist in key lithography technology, and it's one of the very few strong EU tech companies in that space. So 2022 has been a really challenging year for investors. Rising inflation, rising interest rates, derating equity markets. We had a bear market in many major global equity areas. And I think looking forward into 2023, it looks also quite a challenging period. The market is moved to price in peak interest rates in the US and elsewhere. I think having been too optimistic with respect to the interest rate outlook, they're now much more plausible in terms of pricing of expectations, and we can expect in coming months that central banks may well cease their tightening cycle. And that is clearly a positive for markets, and we are beginning already to see some moderation in terms of inflation rates. But looking forward, I think the growth outlook does remain relatively challenging in response to tightening liquidity and need to take heat out of the US labour market in particular. We do expect a slowdown to progress, and that has implications clearly for corporate margins and corporate earnings, and we expect quite a tough period for both in coming quarters. And frankly, I don't think that's fully discounted yet in terms of market pricing. Markets are not reflecting, I think, the downturn in earnings, which is likely. That said, again, markets have moved a long way in terms of pricing on interest rate expectations, and there is a case that can be made that perhaps the US economy, for example, can avoid recession. I think that's less likely than not, but it is a possibility. I think the outlook from here is one whereby we are going to see some moderation in terms of earnings growth. That is going to place some pressure on equity markets as we move into 2023. But what I would say is that our mindset has changed somewhat. It's a much more balanced outlook in the sense that many of these issues, whether it's inflation rates or indeed growth, are well known, well flagged, and a lot of this is already in the price. So it's a much more balanced outlook, and having been relatively cautious, remaining so in the near term, we are now looking for opportunities to deploy capital, having been sitting on quite high cash levels for some time now, looking for opportunities both in the listed space and in private markets. And I think they will be forthcoming in coming quarters.